Hello and welcome once more for a new video presentation on the SYSCOHADA Accounting Framework. This particular video will be a worked example of a practical exercise on depreciation and disposal of a fixed asset. So if you are ready, let us look at the question which you are going to use for this exercise. Motorway Construction Company owns a tractor that originally costed 6 million francs CFA with a 20-year useful life. The tractor was purchased on the 10th of March 2000, and Motorway uses a straight line depreciation method. After 10 years of ownership, the tractor was sold for 24,500,000 francs CFA on the 22nd of June 2010. Show the relevant journal entries in each year from 2000 to 2010. How would your answer differ if the tractor was destroyed by a flood instead on the 22nd of June 2010? So, if you notice, this question has different phases or different steps. First, there was a purchase of a tractor on the 10th of March 2010, and then there's the depreciation of that tractor each year until the 22nd June 2010, when the tractor was disposed or was sold. You then have the sale of the tractor on that 22nd June 2010. And then further, the question asks, how will our answer differ if the tractor was instead destroyed by a flood on the 22nd of June 2010? So let us break down the question into the different stages so that we can see the accounting treatment at each stage of the question. Motorway construction companies own a tractor that originally cost 36 million. That is the original cost. The question did not mention that the tractor had a residual value. Hence, we assume that the residual value is 0. And in that case, that 36 million will be the depreciable amount. It will be depreciated based on the useful year, which is a 20-year useful life. The tractor was purchased on the 10th of March 2000, and hence we are going to use the straight line depreciation method. So normally the depreciation is based on the depreciable amount and the useful life of the tractor. However, there is a problem. The tractor was purchased on the 10th of March, so the tractor was purchased during the year. So the next question is, how should we account for purchases that are made within the year or within the month and not during the first day of the month or not during the first day of the year? For depreciation purposes, if a purchase of a fixed asset falls in between the 1st and the 15th of a given month, then we are going to account for the purchase as if it occurred on the first day of the month. But if the purchase falls in between the 16th and the 31st of the month, then you are going to account for the purchase as if it had occurred on the 1st of the following month. This is only for depreciation purposes. If it's to record the transaction of a purchase, we record the transaction on the day it has occurred. But for depreciation purposes, we assume that if the purchase fell any day between the 1st and the 15th, we account for it as if it occurred on the first day of the month. For example, if a purchase was made on the 8th of February, we are going to consider that the purchase was made on the 1st of February. So in our example, where the purchase was made on the 10th of March, we are going to assume that the purchase was made at the beginning of the month on the 1st of March. So as we have seen when to start depreciating the asset, the next stage is for us to determine the annual depreciation charge, the depreciation charge each year. And that is simply the total cost of the asset divided by its useful life. Remember that the original cost of the asset was 36 million, or the depreciable amount in this case was 36 million, because we had no residual value and the useful life of the asset was 20 years. Hence, 36 million divided by 20 years gives us an annual depreciation charge of 1.8 million CFA. The annual depreciation charge is based on a year which has 12 months. But remember that in this particular equation, we have not held the asset for 12 months. We held the asset from the 1st of March to the 31st of December. This means that we have held the asset for 10 months. And so the depreciation charge, the annual depreciation charge, should be time apportioned to account for the 10 months ownership that we had during the first year. So in this case, we are going to multiply that depreciation charge by 10 on 12, 10 months out of 12 months of the annual depreciation charge, which gives us a depreciation charge for the first year of 1.5 million. This means the expense which should be recognized during the first year of ownership is 1.5 million. So that is for the first year. Let us go back to the question to see the information that relates to the last year of ownership of the asset, the year when the asset was disposed. After 10 years of ownership, the tractor was sold for 25,500,000 francs on the 22nd of June 2010. So it means that we have held the asset for 10 years and we disposed the asset on the 22nd of June 2010. So if we dispose the asset on the 22nd of June, we are going to assume that the asset was disposed on the 1st of July. Remember when we looked at the slide where we looked at the dates and we said that if an asset is purchased on the 1st, we assume, between the 1st and the 15th, we assume that the asset was purchased on the 1st. So same here, because the asset was disposed between the 16th and the 31st, we assume that the asset was disposed on the 1st of the next month, which is the month of July. So we have to determine the number of months of ownership in the year 2000 before the asset was disposed. So to determine the number of months of ownership, we see that from the 1st of January to the 1st of July, we have a period of 6 months. From 1st of January to 30th of June, we have a period of 6 months. So in this case, the depreciation charge, the annual depreciation charge of 1.8 million must be time apportioned for the 6 months we held the asset in the year of disposal 2010. The depreciation charge of that last year hence will be 0.9 million. After having looked at all of the depreciation charge in the first year, the depreciation charge in the last year of ownership, let us have a table then, a depreciation schedule table, to see the depreciation from the first year 2000 until the year 2010. So this is our depreciation table starting from the year 2000 when the asset was purchased, and you see the number of months of ownership is 30 with an opening book value of 36 million. And as we saw, the depreciation charge in the first year of ownership is 1.5 million. And we have an accumulated depreciation of the same amount. Remember, it's the first depreciation we are recording on the asset. The closing book value is the difference between the opening book value and accumulated depreciation. As you see from the labelings of the columns, depreciation charge will go to account 68 and accumulated depreciation to account 28. The double entry usually is for us to debit this account 68 by the depreciation charge and credit accounts to it by the depreciation charge. During the years 2001, 2002 up to 2009, we have held the asset for the 12 months. Hence, the depreciation charge remains the same, 1.8 million throughout. But remember that in the last year of ownership, we have held the asset for 6 months, and hence the depreciation charge will be 0.9 million. The accumulated depreciation column shows the total depreciation that has ever been recorded on that asset in the financial statements. In other words, is the depreciation for the current year plus all of the other depreciation that has ever been recorded on that asset. So as we have an idea about the depreciation table or the depreciation schedule from the year the asset was purchased to the year of disposal, we can see from the table that the net book value when the asset was disposed of is 17.4 million. Hence, we will need to compare this book value with the disposal proceeds, because the assumption in accounting is to determine the profit or loss on disposal. This closing book value at the time of disposal is assumed to be the cost of the asset when compare the cost of the asset to determine whether the entity made a profit or a loss on disposal. So let us look at that portion then in the equation, the portion that treats the disposal of the asset. I think before even going to that portion, let us look at the double entry of what we have seen so far. The double entry of depreciation and accumulated depreciation up to this point. For depreciation purposes, if a purchase of a fixed asset falls in between the 1st and the 15th of a given month, then we are going to account for the purchase as if it occurred on the 1st day of the month. But if the purchase falls in between the 16th and the 31st of the month, then you are going to account for the purchase as if it had occurred on the 1st of the following month. This is only for depreciation purposes. If it's to record the transaction of a purchase, we record the transaction on the day it has occurred. But for depreciation purposes, we assume that if the purchase fell any day between the 1st and the 15th, we account for it as if it occurred on the 1st day of the month. For example, if a purchase was made on the 8th of February, we are going to consider that the purchase was made on the 1st of February. So in our example, where the purchase was made on the 10th of March, we are going to assume that the purchase was made at the beginning of the month on the 1st of March. Okay, I'm going back to the question. We see that we have treated the depreciation until the year of ownership, until the year of disposal of the fixed asset. And the fixed asset was disposed for 24,500,000. So the next thing for us is to treat the disposal of the asset. So we have to look at the double entries for the disposal of the asset. When we dispose of an asset, we must remove the asset from the books. from the books of the entity, because the asset has been disposed, the asset has been sold, and so the entity does not have control over the asset and hence should not record, or the asset should not remain in its books. So the asset, when the asset is in the books of the entity, it is there at cost under the account, the relevant account 2, from 2.1 to 2.4, 2.5. And also the accumulated depreciation of that asset is also found in the books. So the first thing to do is to close the accumulated depreciation. So on the date of disposal, we close the accumulated depreciation account by debiting the accumulated depreciation account by the balance which is in that account. Remember that the accumulated depreciation account is a balance sheet account, as we said earlier, and so the amount of depreciation ever recorded on the asset will accumulate in that account. So by debiting account 2845, we are closing that account. If we debit that account by the amount which is in that account, or the total accumulated depreciation which has been recorded on the asset, we are effectively closing that account. But it's interesting to see that we are closing the account by crediting transport equipment. So we are sending the balance of account 2845 accumulated depreciation to account 245 transport equipment. The balance is transferred to that account. So it means that in account 245 transport equipment, we now have the cost on the debit side, which was 36 million, and total accumulated depreciation on the credit side, which is 18.6 million. It means that at that given point in time, the balancing figure in that account is the net book value of the asset. And so the next stage is for us to hence debit account 812 by the book value of the disposed fixed asset, and we credit account 245 transport equipment by the 17.4 million, which is the book value of that asset at the date of disposal. By so doing, this double entry, second double entry, we are effectively closing the transport equipment, because if you see the two amounts which have been recorded on the credit side of the transport equipment account, we first have 18.6 million, which was the total accumulated depreciation. Then we have 17.4 million, which is the net book value of the asset. If we add 18.6 and 17.4, that gives us a total of 36 million, which is the cost of the asset and was on the debit side of that asset. So you see that this second double entry serves to close the transport equipment or the account 245. But we are closing it by debiting account 812. Remember that the sale of a fixed asset is not part of the normal operating activities of the entity, and that's why it falls, the sale of the fixed asset falls in account 8, which is an account which records non-operating activities. So in this, with these two double entries, we have accounted for the cost of the fixed asset which is disposed of. But to account for the income we receive, we will first debit account 521 bank, as the sale was made through check, and we credit account 822 income from the sale of a tangible fixed asset by the 24.5 million, which is the disposal proceeds, or from the sale of the asset. So we debit, in this case was account 521. In another case it could be cash, or maybe a sale on credit. And then we credit account 822, which records the income from the sale of tangible fixed assets. Remember that as it is a non-operating activity, that is why the income and the book value are recorded in account 8. So there you have the double entry for the disposal of the fixed asset. The question, however, asks what will be Or how will our answer differ if the asset was destroyed and not sold? In that case, if the asset was destroyed and not sold, it means that the asset will still have to be removed from the financial statements and accounted for as a disposal, but a disposal with no revenue earned. It means that our disposal proceeds, you can consider that our disposal proceeds in this case is 0. So, good things don't last very long. We are at the end of the video presentation. We hope you have enjoyed yourself and that you have learned something with this worked example on depreciation and disposal of fixed assets. Do check out for more video presentations on the SYSCOHADA Accounting Framework. If you have any questions or suggestions, do not hesitate to contact us or to place a comment on the comment section. Bye bye for now.